Stocks are small ownership pieces of a company. They became a normal way for businesses to raise money and for ordinary people to share in growth, profits, and sometimes voting power. What makes stocks important is that their value is tied to how a real company performs. So beginners hear about them early because they are one of the clearest ways to invest in business itself. A bond is closer to a loan than to ownership. Governments, cities, and companies issue bonds to borrow money, and in return, they promise interest payments and the return of principal at maturity. Beginners usually hear that bonds feel steadier than stocks because they are built around lending, income, and repayment dates, rather than open-ended business growth. A mutual fund gathers money from many investors and puts it into a portfolio based on a stated goal. That structure became popular because it gave people a way to own many securities at once instead of trying to build a portfolio piece by piece on their own. What makes mutual funds different is that you are buying into a managed pool, not choosing every stock or bond yourself. An ETF also pools money into a portfolio, but it trades on an exchange like a stock. That mix of fund diversification and stock-style trading is why ETFs became so popular after the first domestic ETFs appeared in the 1990s. Beginners hear about them constantly because they feel simple, flexible, and easy to buy in a regular brokerage account. An index fund is built to follow a benchmark instead of trying to outsmart the market security by security. That idea became powerful because many investors wanted broad market exposure with a more rules-based and usually lower-cost approach. What makes index funds important is that they turn investing from constant picking into simple tracking. Money market funds are mutual funds that invest in very short-term debt, cash, and cash equivalents. They became a common parking place for cash because many investors wanted something more liquid and conservative than most other funds, even though returns have historically been lower. What makes them different is that they are used more for stability and short-term holding than for long-term growth. REITs were created by Congress in 1960 to let individual investors access large-scale income-producing real estate. A REIT is a company that owns and typically operates real estate or real estate-related assets, so it gives people exposure to property without having to buy and manage buildings themselves. That is why beginners often hear about REITs as the stock market version of real estate investing. Gold and other commodities are physical asset categories that many investors connect with inflation fears, uncertainty, and the idea of storing value outside normal financial assets. Official investor education materials list precious metals and commodities as separate asset categories, but regulators also warn that they carry their own risks and can be volatile rather than truly safe. That is why beginners hear about them so often in emotional times, even though they work very differently from business ownership or lending. Crypto assets are digital assets generated, issued, or transferred through blockchain or similar distributed ledger networks. They became widely known because they were presented as a new kind of internet-native asset, but official investor alerts keep stressing that different crypto assets have very different designs, risks, and levels of protection. Beginners hear about crypto early because it is everywhere, yet it stands apart for its volatility, fraud risk, and weaker protections when funds are held with crypto entities. Options are contracts whose value comes from another asset, and they give the buyer the right, but not the obligation, to buy or sell on specific terms within a certain time. They became popular because they can be used for speculation, hedging, and more complex strategies, but that same flexibility is what makes them harder for beginners to understand. What separates options from the earlier investment types is that they are derivatives first and long-term beginner holdings only by exception.